Hello and welcome to the DIY Investing YouTube channel. We are working through every company in the S&P 500, and today is the Charles Schwab Corporation, ticker SCHW. Over the next few minutes, I'll discuss my thoughts on both the valuation of this company and its business quality. Now let's dive right on in. First up, this company is in the capital markets industry, has a $122 billion market cap and a $52 billion enterprise value. This difference here suggests that it is holding quite a substantial amount of cash and assets, which is allowing the enterprise value to be substantially lower than the market cap. That is a very nice sign. Now, business description. Charles Schwab provides wealth management, securities brokerage, banking, asset management, custody, and financial advisory services. They have investor services and advisor services. So investor services is that retail brokerage firm, and the advisor offers other more upscale services to business owners and other things like that. So Schwab is one of the main brokers in the United States for securities, whether it be stocks, bonds, ETFs, that sort of thing. I actually have Schwab as one of the accounts I own, and I think they're a great service as a customer. So I'm really interested to see how they are as a business. Now, return on equity. This isn't actually a really good chart. I like what I see here. First and foremost, there is 20 straight years of profitability. They did not lose money in any year in the last 20 years. And if you have 20 straight years of profitability, that is the first mark that I like to see as a high quality business. So I really like what I'm seeing here. Positive in terms of high quality business. Now, something weird happens in 2007, 2008. Basically, it spikes the return on equity. I don't really know what's going on here. I do like they're making more money during 2007, 2008, and 2009 instead of less. So despite the recession, they're making a lot of money here. It could be that share turnover increased during the financial crisis, and a lot of shares were being traded very, very quickly, and that could have given them more broker fees or something along those lines. I don't really understand. So it would require some further look here of how you got up to a 55% return on equity. However, if we just look from 2011, where things are a lot more stable and even, this looks like a really good business. You have a return on equity of 12%, 10%, 10%, 11%, 11%, 12%, 13, 17, 17, 8, and 10. Basically, for the last decade, besides 2020, which is the meat of the pandemic, you had double-digit return on equity every single year. And it's overall very stable. You don't see any cyclical performance. This is an up, down, up, down, up, down. And you do know that even in the last really major recession, the return on equity actually spiked up instead of spiked down. So you can have some comfort that this is a strong business model. Now, the numbers are a little lower than I'd like to see. I would prefer to have these 17% numbers, anything over 15%. But, 10, 11, 12% is a good, stable return on equity. You're making lots of money. This is the type of business that could compound a lot over time. So high quality business from what I see here. Now, the 10-year median returns, you do see return on assets of 0.9%, return on equity of 11.7%. This is likely because it's structured as a bank, at least part of the business. And so you're earning you have a lot of leverage here that's leveraging these return on assets to the 11.7% return on equity. Nothing concerning there, but it's something to just be aware of. Now, the PE of 21.1 is quite high. However, a high quality business like this with these characteristics, it's not abnormal that you'd have a PE that's actually quite high. So what justifies a PE of 21? It would be very, very strong growth. And that is what we see with these 10-year CAGRs. You have your net interest income growing at 16% a year, gross loans earning at 13% a year, earning assets growing at 21%, and deposits growing at 22%. These last two are really what you want to see. A business like this is driven ultimately by its earning assets. So this number is a huge driver in the long-term performance. If you can maintain a similar growth rate for the next decade, then the PE of 21 is not only going to be cheap, it's going to be extremely cheap, because this is the sort of thing that doubles earnings per share multiple times in a decade. You might be up 4x in a decade with this sort of earnings. And let's see how that looks over the last decade. And you do see something similar. You've gone from 70 cents per share in earnings to 280, and that's a 4x over the last decade. If you were to repeat that, that could 4x again, and you could have earnings per share at like $11 per share come 2031, which would mean you'd be at something at like 5 times the current stock price. So there's a lot of room here for growth. The stock could easily 4x again over that decade if it was able to have that growth. So PE of 21 is not unreasonable. It could actually be a fair value, offsetting some of these risks, or undervalued if you're able to replicate the last decade here. One thing that you really like to see here is how you've taken a net interest income has grown from 1.7 billion to 8 billion over that period, and it's really driving that growth over time. Another thing you like to see is that the assets to equity has been, well, no, let's not go to that piece. That in addition to that, they've been paying out a dividend this whole time. So not only do you have this 21% growth, you've had 21% growth with a dividend being paid out, and a dividend that's pretty significant. I mean, this is like a third of the earnings per share at the beginning of the decade, and maybe 25% of the earnings per share at the end of the decade. So you're getting an even better overall return than this suggests, due to the fact that they're able to pay a dividend and still grow. If you're enjoying this video so far, please hit that like button at the bottom, and don't forget to subscribe. I need your subscriptions to grow the channel. Thank you for listening to this, and let's continue on with the income statement. So income statement, see if there's anything interesting we can learn here. First, you can see provision for credit losses is basically nothing. That's actually a really good sign. So despite being, in the financial services type industry, they're not really having to take a lot of credit risk here, which is really, really good for you as an investor. And it explains why they didn't suffer a lot during 2007, 2008. So another piece you see here is their interest income is quite high, and they have very, very low interest expense. This is due to the circumstances of the business operating in that capital markets. They're having these brokerage. They're not having to pay very high interest rates to their brokerage customers, and yet they're able to earn very, very attractive interest income, 10, 15x higher than the amount that they're having to pay. So that's actually really good for them as a business. Let's look at the non-interest expense and revenue. One actually thing that's really interesting here is they have non-interest expense basically very similar to non-interest revenue. That means they're able to float their whole business on this interest side with the non-interest income that they're receiving. So they're receiving a substantial amount of non-interest income, and that is helping them to really improve the overall economics of this business. Without this non-interest revenue, this business would look a lot poorer and would actually lose money because they're not earning enough simply from their interest. But overall still looks really, really good. Now, the only downside here is that they have diluted over time. So I don't know why they're diluting so much. They have a very big dilution event here, and it looks like in 2020. This might be the acquisition of TD Ameritrade. I'd have to take a further look deeper down. Now, they're investing more than I would expect in PP&E. I don't really know what that is in this sort of business, but they have a lot of securities investments. Again, this is the capital markets type structure. It's going to look very different from some of the other videos that I've done, because you're going to be holding a lot of cash. You're going to be holding a lot of securities and equivalents. This is just financial markets in general. You're going to have these deposits as a liability, and then you're going to be offset by these securities. It's just how this sort of company is going to work and look on the balance sheet. Now, cash flow, so you do see a significant amount of stock-based compensation, but I think this investments is where I think the dilution is. Or no, let's see. Do they have acquisitions? Acquisitions, actually. So they paid $14 million in terms of acquisitions, and I think that's related to the TD Ameritrade. You had to issue a bunch of preferred stock. You had to issue debt, and so that's really the driver here. So you do have some dividends being paid. Let's see, and you're not buying back stock regularly, which I really don't like, because it means you're not buying back stock regularly, yet you're diluting on a regular basis, and that's a lot of money. I mean, you see the cash flow from operations jumping all around in different places. It's certainly not, cash flow from operations is certainly not nearly as stable as your net income number, and that's due to these working capital changes fluctuating a lot up and down. So it's hard to make sense of this in terms of long-term predictability of that cash flow, which is what really matters more than the net income. But if you trust the working capital to work itself out over time, then you can use the net income numbers as a simple baseline there. Nothing in big takeaways on this cash flow statement. Mainly is just that the stock-based compensation is probably a little higher than I'd like. You are steadily diluting. They did make an acquisition here, and it's probably a little too early to tell how that's going to look long-term. I do think that acquisition is driving this drop in return on equity, and so it's going to take some time for that to come back. But if this is what occurred, is basically you had this acquisition in 2020, it drops your return on equity, and as we've already seen it starting to come back, and you're going to continue to stay above that 10% range, then I think this could be very attractive still long-term. because it suggests that this dip is actually just more of a short-term aberration, and you're going to get close to these 13-17% returns on equity. Overall, this company looks really attractive. Charles Schwab will go on my watch list. I love that it has 20 straight years of profitability. I love that the 10-year median returns are in your double digits. You're not dipping at all. You're in a very stable run rate. They're turning very high growth rates into profitable growth rates on the EPS line. So you are seeing that. And they're also paying out dividends at the same time that they're growing at 20% a year. Very, very attractive business. I'm excited to put on my watch list. If you enjoyed this video, please hit that like button. I need your likes. Your likes help the YouTube algorithm know that you're enjoying this content. So please hit that like video on every video that you like of mine, and subscribe to the channel so you can get notifications as I upload new videos each and every week on every company in the S&P 500. Thank you for listening, and until next time, stop paying fees, start building wealth.